All right, let's rock and roll. So in the last segment, we were talking about EBITDA and enterprise value and cap rates and net operating income for real estate. A lot of numbers. So before you go on to this one, you might say, it might be worth an hour to go through the previous segment a second time. Might be worth it. They say that repetition is the mother of learning. I don't know who said that, but it may be true. So if you want, you can move forward, or if you feel, I'd like to get those numbers a little more solid and try to understand the big picture concepts. One of the things that Robert Kiyosaki gave me, which is just an incredible gift, is understanding the importance of the big picture. And to always bring it, start big before you go small, and then it's also helpful to bring it back big again. So now we're going to get into these numbers a little deeper in terms of what makes a good number and what makes a less attractive number. And, it really comes down now to saying, okay, I have ABC here, I have XYZ here. How might I choose between the two? And we'll get back to earnings and enterprise value. But let's just look at it from a standpoint of growth now. Remember, what did Benjamin Graham say? Let's go back to it and let's take a look at what he said again. Let's bring that back up. Find it here. Here we go. Where is that little thing right here? Is this it? Is this it? That's not it. Is this it? That's not it. There it is. It's earnings and it's what? And it's growth, right? It's earnings and it's growth. That's really what his formula boils down to, is those two things are really, really big. So how do we value a stock? Well, if we were to look at growth now, we've talked a lot about earnings and enterprise value. Let's talk about growth. Well, here I have company ABC, and here I have company XYZ and the amount of money they earn. So these guys earned some, and these guys lost some. So at first I might say, oh, ABC, that's the company I want. ABC, they're better than these guys. But if I begin to put it in context, you'll notice that in these statements we had the current month and the year to date, and some of them we had 2 or 3 years in a row. A lot of these statements look at several years of data to put it in what we call context, because that might be changing our mind. Because here we see the earnings are what? Falling. And do you remember with GameStop how quickly that started to happen? Well, here we might have a company like Tesla that's never earned any money in their life, but they seem to be getting closer to turning a profit, right? They seem to be getting closer. Maybe they will, maybe they won't. But this is a big deal because it looks like this company is in decline in earnings. Looks like this company might have a chance to turn positive and grow someday. So I'm going to start this segment with giving you something that you can begin to practice with to get better at this. And a little fundamental analysis is better than none. Let's dispel the myth that by doing a fundamental analysis on its own can give you this feeling that, well, it's guaranteed to work out now. The sooner we can let go of that myth, I just don't believe there's any investor in the world that gets to the point where after doing a fundamental analysis, they say, well, that's the only pillar I need. I don't need any other pillars. The one pillar of fundamentals is fine. There's a reason for technicals, as you'll see later. There's a reason for the cash flow pillar, as you'll see. And there's certainly a reason for risk management, because things change. And that is a real key in the 4 pillars of investing, is that things change. There is a misperception that the stock market is like Vegas and gambling, that you would have to choose your number on the roulette wheel and you either win or you lose, and that's it. And you had to have that knowledge beforehand, or you need to know the outcome of the football game to win at the sports betting booth. Not at all. We have many things we do to manage risk, many things we do to adjust. The world is fluid, things change. We just want to start off with some good criteria. So let's begin practicing, and I'm definitely going to be unapologetic. Is, look, if you like what you're learning here and you think the quality is okay and how our style is okay, I'll be unapologetic and put on my salesman hat and say, get a coach and begin practicing this type of stuff. So when we look at stocks, okay, and I'm going to go with stocks, and I'll let Kenny and my friend Than and these other guys handle real estate more, but I'll be a little bit more bold here and say here are some basic criteria for stocks. When it comes to real estate, I'm really interested in I'm interested in things like interest rates. I'm interested in NOI. I'm interested in cap rate. I'm interested in stuff like that. When it comes to stocks, we're going to start with a few ideas here. We're going to look at the enterprise value. Okay, so if we took the market cap, we say, okay, here's how many shares they are. Here's what they're paying for those shares. But we're also going to look at their balance sheet and their income statement to find out the actual value of the enterprise. And then we're going to see the money it creates in EBITDA. And then we're going to look at how much we pay in price as opposed to how much we get in earnings. Okay, so these are all about very similar numbers. But then we're going to combine this with growth. That way we're going to get some good basic data on those Benjamin Graham fundamental numbers of earnings and growth. We have some good numbers on these. So we're going to look at the amount of money they earn compared to the enterprise value. We're going to look at the amount of money they earn compared to the stock price. And we're also going to factor in growth with something called a PEG ratio. And we love this because when you think about it, we want to know what price we should pay. That's what we pay. But we want to know what value we're going to get, which would be what? Earnings and growth. So in this one number, we get to play around, and with these two numbers, we're getting some pretty good basic data on what this company is without having to go through an insane fundamental analysis. Now, you could certainly do that. This one's not insane. But you'll notice that here we have price, earnings, and growth that we really like, and we have enterprise value over EBITDA. These are the two that we're going to start practicing with right here. But if you want to know this other stuff, and there's more you can learn and study as you want to go through this, this is the trailing. This is what they expect. This is usually, sometimes you'll see a CTTM here called trailing 12 months. But one of the assignments that you could do with a coach is to say, I'm going to pick 5 companies, and I'm simply going to get these numbers. Now, once you get these numbers, what's a good number and what's a bad number? Well, there's 2 ways I would tell you that you could work with this here. Okay, couple of different ones. Well, let's go back to this. Generally, in the market, if I were to see an EV over EBITDA that was less than 10, I'd probably be more bullish on that stock. And now, please understand, this stock might even be in a downtrend because the lower the price gets, the more money it's making for the price, if that makes sense. So if I have a stock that's going down like this, well, if it used to be, let's say the stock makes $100. Well, if it used to be $10, now it's $5. Now $5 getting me $100 and $10 instead of 10. Make sense? So, this is a good number. Not necessarily. I don't like to put a stamp and say this is a good number. Period. But generally, the way we really pick stocks, if I can go back here, is really like this. Is we say, well, how does this one's numbers compare to this one's numbers, right? If you get any 2 people, okay, and you compare person A and person B in a physical with a doctor, that doctor will tell you, well, this guy's much healthier than the other, or this guy over here is much healthier than the other, or they're very similar health, right? But if you were going to be a life insurance company and bet, maybe this is the one you bet on, right? The problem we have is to do that one at a time with all kinds of stocks, with thousands to choose from. It's hard to run searches to get ideas. if you'd want to compare everything. So what we do is we say, okay, look, if you were a doctor, what would a really scary BMI be? He says, well, you know what? If you look at a body mass index, let's just use health, a body mass index that is greater than 30, that person's not just overweight, that person's obese. And we just know that in the general population, there's a lot of people that have a BMI that's less than 30 or less than 20 or 16. We just know if you want to find heart attack victims, the people that are going to die the most, I'll tell you, these guys are going to have a higher death rate than others. So we say this is a really bad BMI right here. Anything over 30 would be a bad BMI for a person. So that's if you were a doctor evaluating a body mass index. You know, how fat is Andy is what we're really saying. Isn't that nice? You know, instead of my wife saying, Andy, you're really fat, just say, hey, Andy, you know, BMI is looking up there. You know, she could say it that way maybe. And so what we can do is we can say, look, companies that have an enterprise value and an EBITDA ratio that's less than 10, you know, we could feel, you know, let's look at that group first and then compare those guys apple to apples. If we have an enterprise value over EBITDA of greater than 20, we might lean a little bit towards the bearish side on those guys. You know, price earnings and growth greater than 1, price or less than 1, very bullish. Price earnings growth greater than 3, maybe bearish. Now, let's not get pigeonholing ourselves into saying, well, this stock, the wrong way to think about it is, oh, I have a winner and oh, I have a loser, right? Oh, I have a winner over a loser. Not at all. This is basically the checkup. You still don't know what's going to happen. This is basically the physical, the checkup. So when we run stocks, okay, and we want to run a search, I might develop these 4 criteria in a search. And there's lots of different ways to do this. There's, you know, Yahoo Finance you can do it on. And if we look here on Yahoo Finance, you know, here's a company that we're going to use as an example throughout the 4 pillars. Is here I ran this search, and I ran this search for large cap or mega cap, a price greater than 10, an EBITDA, right? An EV over EBITDA that's less than 10, and a PE ratio that's less than 1. So all of a sudden, I can go and I can take this criteria, I can put it in a computer for a search, right? And if you'd like to learn how to set these up in different software and different ways, our coaches are available for practice and help and all this. So get in that program to actually do this stuff. But I like Kraft Heinz is an example for this program, and we thought, hey, let's just do this for 4 or 5 months. Let's just pick this one for 4 or 5 months, and then we can, when we do the 4 pillars of investing class, we can use Kraft Heinz as example, and it's going to be fun because we're going to do it with the fundamentals, we're going to do it with the technicals, we're going to do it with the cash flow, and we're going to do it with the risk management. So if they go out of business, so a couple things can happen to Kraft Heinz. They can either recover from the problems that they've had. And I think one of the reasons they showed up on this search is even though this company's in trouble, you know, their price is down to, you know, $32 as of this search. It could get to 25, it could get to 20. But the question is there value here? You know, Warren Buffett seems to think so because he owns this company and he hasn't sold it yet. So we'll try to find out if this is a buying opportunity, possibly. Now, this is where I get myself in trouble, and we got to go back to the disclaimer of I'm not recommending this as a stock to buy. I'm simply saying this is a good example. When I bring up that disclaimer on every pillar, and it says the stocks I use are for illustration purposes only, that's exactly what it means. Shoot. 10 years from now, we might look at this and say, "Cow, remember that? We thought Enron was bad. Kraft Heinz went out of business, and Warren Buffett had to eat a little crow by holding on to that." But maybe also we look at it and say, "Man, we had a good one with this." But the risk management is going to determine whether we stay in this or whether we get out of it, and the cash flow is going to determine what prices we get and how we decide to get into it. So I just put a check mark by this one because it happened to come up on this search, and I happen to know that it's a Warren Buffett held company, but it's one of the largest shareholders is Berkshire Hathaway. So we'll use this now and again as an example. And you can click on this and, okay, here's some information on Kraft Heinz. And this 1 month looks bullish to it, but they're actually, if you went back a year, they'd be getting their butt kicked. So here's one, Yahoo Finance you could do it with. You can practice fundamental analysis stocks with this thing called FinViz. I can say, look, here's my price is over 10. Here's my peg is over 3. I want things that are shortable. So here's a bearish one. So here's Guess Jeans, and I noticed Guess Jeans, and I thought, Blockbuster was falling out of vogue. And I thought, when's the last time my wife bought some Guess Jeans? And I thought, my wife's pretty fashion conscious. I don't think she'd be caught dead in some Guess Jeans. Now in high school, she might have thought she was the bomb, but she hadn't bought any Guess Jeans. They're not the coolest jeans. So maybe, I can mouse over this, start doing a little technical. So we'll look at some of these examples. Now technically I can see it's in a downtrend and, bumping up here. Maybe it's a time to maybe put a target on this of $14 and say, hey, I can make a couple easy bucks right here, right? Maybe so. I don't know. Time will tell. We'll look and see if it went up and down from here in the future. That's why exit strategy is so important. Now, let me show you one more. This is kind of a cool program that I use. I ought to show this. These guys right here, I mentioned this Finbox, and I don't like recommending one thing over another because there's a million of them, right? And some guys like it's like Ford and Chevy, oh, Fords are better, oh, Chevys are better, and they fight, and I can drive either one. So right here we have some screeners right here, for example, and I could go into some of my save scans and notice that here I have these same fundamentals set up here as I do. I have this in Yahoo. I have this in FinViz. It's the same thing, and the coaches can help you through this and practice this over and over and over. So if I bring back my my fundamental criteria right here, which is this, I've got basically 4. I've got stocks over $10. I like stocks that can, if you're less than 10, the stock might not be that great, and if you're trying to short it, there's not much left in it maybe. Large cap stocks that are liquid, in theory they're well established, especially on the bullish side. EBITDA, we have a bullish number of less than 10, a bearish number of greater than 20. And we have a PEG ratio of less than 1 and a PE ratio of greater than 3. And we'll get into some more of these numbers as you get into the Mentor Club and other stuff. So notice that I've got those same numbers right here. I've got my enterprise value less than 10. I've got my PE, I didn't put it up there, greater than 3. Let's put it up there. And this is for which one? Less than 10. I want it greater than 1, on a bullish type of deal, and so I'd update that. And then I want my market cap greater than 10 billion and some price stuff here. So I can click on these and it'll give me lists of stocks, and you'll notice in a Benjamin Graham situation I can mouse over these and see how many of these would fit that Benjamin Graham formula and what their upside range is. Now notice he didn't choose a target, he chose a range, and he can be so wrong on this, right? So it says here's the top matches right there. Obviously these prices are going to be lower because we're looking for bargain stocks. We're looking for stuff that might be a little bit cheaper in terms of the S&P, right? A little bit cheaper in terms of that. So we're trying to find discount stuff so they can outperform in the future. And I can also run the bearish scan, right? And so these are ways to get really stuff. Notice that the Benjamin Graham formula, there's not a lot of here with upside because of the fundamentals we put in. We're saying, gee, this doesn't look too good right here. Well, it shouldn't look too good, and maybe these are a little overpriced. Maybe these are a little bit overextended and done better in price than we thought, and they're full of money and ready to come back down and revert to the mean. So there's all kinds of cool stuff. We in our coaching program, we have assignments for people that really want to practice this and do it for real. And we have these little coaching groups where you can, get to do this with a handful of other investors. Really fun stuff. to do it in whatever time it is for you now, right? Whatever, stocks are big or small. So this is really good to complement the video to do some stuff that's current live, right? After this is, we'll probably redo our videos every 5 or 6 years, but it's still nice to have some current stuff. So there's some ideas in terms of that. Now, we look at going big and small. This is a fun idea. Here you have Steve Jobs, and that's his house when he first started, Apple. He started Apple in that garage right there. So here you have this humble beginnings, basically, and he had to sell, him and Wozniak sold their calculators and their Volkswagens to get started. And which house is Steve's? Pick it out. Which house is Steve's? I'll tell you which one it is. It's that one right there, because that one has an apple in it. See the apple on the front porch? And so there's Steve's house. Well, it's hard to see that, right? Because he didn't have a 10K. But this GM, I mentioned earlier, Romney and Obama are fighting on whether they should go bankrupt because they can both see the 10K is a ticking time bomb. So I really love to go short. When we do our meeting with Monday with the guys I trade with, I pride myself on coming up with a short, even in a bull market, because I just love to find them and see if I can find shorts. And it's exciting to balance your portfolio with a few shorts as well along. Very much more risky to go short. Much more risky to go short. But nevertheless, I think shorts are sometimes easier to find than long. Sometimes I think they are. And that you can be opportunistic there. So begin to practice with this stuff. Begin to practice with software. You can click on stuff and see their chart and begin to to practice what you think can work for you with some of these tools. Keep it simple, keep it basic. So here's how you might do it. Maybe you go out and find a handful of these companies. We have thousands that we do, and so maybe you run a search and it says, okay, we'll hide this. Say, hey, here's 124 that fit that criteria. So you now narrow the universe from like 10,000 down to 124. You can sort it by price and say, okay, here's some by price, and I can start looking at these that are over $10 and just begin to practice with some of these and start looking at them, right? And see which ones. Oh, CarMax, interesting. Okay, let's look at their stock, and then we'll go into technicals and start. So once you get a handful of companies, ABC, XYZ, look at the PEG ratio and start comparing one to the other. And we like compare stock to stock, right? Stock to stock. And we also like to do it versus the sector. So if the average in the sector is, let's say, 2, but we find pegs that are, maybe this one is 0.6 and this one is 1, well, they're both doing better than the sector, but let's say this is 1 and this is 0.6. This is a regular one. This one's really, really low, so maybe we give that a nod, right? Comparing apples to apples. Go back to the analogy of the doctor giving a physical on a person, trying to find someone who is a potential Olympic athlete, a potential astronaut, someone who's going to be physically resilient as opposed to someone who might not be, or be like a doctor who says, look, insurance company, I'm going to show you the 5 people that are going to have a heart attack most likely. And so you compare the person to the general population or their state or their country, and then you compare person to person. And that's a fun way to do fundamental analysis, right? Now what we're going to do is start getting into paper trading. Now that we're getting closer, we're going to finish off corporate fundamentals now, and we're going to move into sovereign fundamentals in the last part of this pillar. But this gets pretty important right here to begin action. So I would recommend that you get yourself some type of a spreadsheet or some type of a notebook, and they'll certainly help you this if you want to participate in coaching. But you put in a symbol, ABC and XYZ and Acme and whatever comes up on those searches, right? Pick just a handful of 2 or 3. You're just practicing. You're just practicing on paper. and you say is a large cap, and you put in its cap rate. So okay, this one was 11 billion, and this one was 13 billion, this one was 10 billion. You put in their price. This one's $32, and this was $46, and this is 110 or whatever, right? And you'd have a bullish, and I failed to put this here. You'd have a bearish as well. I should put that in. And you would compare, the peg. Oh, this one's got a peg of 1, and this one's got a peg of 0.5, and this has got a peg of 8. And then you look at the EBITDA over enterprise. This one's got one of 9, this has got one of 6, this has got one of 5. And then you do the same for the bearish type of stuff, okay? So get yourself a little notebook or sheet or spreadsheet. I just did a spreadsheet here. It's an Excel spread or a key, numbers in Mac. And you can get this and start adding columns adding columns here if you want to put more in, and just start doing doing a breakdown here of this stuff, right? Just start doing. I shouldn't do this live breakdown. Maybe we can do it like this, bearish, like that. Just do it right here on the fly. Of bullish criteria and bearish criteria when you look at your breakdown of how you do it. And here they are. Bullish criteria, bearish criteria, EBITDA. We have the elements from Benjamin Graham, and begin to practice finding these and evaluating these. And then once you put a few in a little spreadsheet, it goes really fast on how you do this. Now, I do not do a spreadsheet anymore. This is just for practice. I don't, write these out and put these in. I just look at them and start picking them. And you'll get to that level too. But for now, let's go ahead and practice and just see if you can find 3 stocks that you can put a symbol and fill these out. 3 stocks over here that are bearish, and come up with 3 bullish practice trades and 3 bearish practice trades. And then, if you put them in a paper trade account, you can't lose any money by practicing. And so this is why you took the course, right? This is why you invested all this time, is to start learning how to evaluate these. And I hope the epiphany is, it's like, my gosh, I can begin to follow what Benjamin Graham said. I'm probably not going to be the next Benjamin Graham. Maybe you will be. But at least I can say, you know what? Okay, this is what one of the smartest fundamental analysts ever said, that if you can start looking at earnings and growth, you're heading in the right direction, right? And so now you have an opportunity to actually do some numbers with earning and growth. Mine are a little bit different than his, as I've developed my own style from my own mentors. But essentially, it's about the same 2 things, these elements of growth and these elements of earnings. And these, we found with our students, have been a great way for them to start, a great way for them to learn and begin doing fundamental analysis. So a shorter segment here, which we'd like. If we can get one of those, boy, we'd like a shorter segment. Here's what we do. Get with your coaches, right? Prepare to report to your Cashflow Academy coach. Do a fundamental analysis on 3 stocks for bulls, and do a fundamental analysis on 3 stocks for bears. Then compare those to the average in the sector. Run a scan for strong peg ratios and weak peg ratios. You can do that where? You can do that on FinViz. Here it's over 3. That's a weak peg ratio. Definitely find ones that are shortable. They don't have EV over EBITDA here. That's fine. And, you're still going to might find some nice opportunities here for some shorts. And then off you go. Okay, very, very cool stuff. When we come back, we're going to move from personal, corporate, sovereign. It's my hope from the bottom of my heart that you're enjoying this education. If you are, send me a letter. I love to get those. And I don't really publish many or anything like that. I don't worry too much about stuff. Sometimes the marketing department will. But for me personally, I just love to hear good feedback. I'm starting to pick it up, man. I had to take it, I had to go through this segment twice, but man, I did it and I got it. That stuff makes me feel good. So this was a huge part of our fundamental analysis pillar, because we went through so many numbers and really dug down to details. Let's go back big picture one last time. What are we really trying to achieve with this? Well, we're trying to find us a good player. And we do that with their current production and their potential, right? Same with the stock, current production and their potential. And that's really what these numbers do for us is, what's their current production? Here we have this growth idea. What's their potential? And that's a basic primer on fundamental analysis for looking for stocks. Awesome job. Great job.